Hey, we're live.
Hey, everybody. Happy Tuesday to you all. Good to see everybody again. Hey, Walt.
Well,
Hey, Percy. Hey, Scott. Hey, Klaus. Ari. Scott. Thank you guys all so much for showing up today for another Stocks from Scratch deep dive. I'm Brian Feraldi. That's Brian Stoffel. And Brian, we have a theme apparently going on in the month of April, and that theme appears to be semiconductors, although
yeah,
that's not anything that we sent to do. So as usual, we polled our audience in our Wednesday newsletter.
that's a tight race there.
This is the tightest race I've ever seen. 27.7% of people voted for Intel, just nudging out Marvel, another semiconductor stock. So
And Broadcom was last week, if I'm not mistaken, right?
Broadcom was last week. So we're kind of going to be going through this and researching it to the best of our abilities. And we'll go from there. For context, I like to think about, hey, how hard is this stock to research? Is it easy or is it hard? If you asked me, I'd put it about here.
Yep, that's what I was going to say.
Semiconductor stocks are definitely on the harder side of things to analyze. And I don't know Intel well at all. I obviously know the business. I'm sure you do too. But I just know that things have not been going well for Intel.
I mean, the bottom line about Intel is like, and I mean from 30,000 feet over a long time frame, is that they're the only chip designer that also manufactures their chips. And that has been like a key differentiator. I'm sure, as you guys figured out last week, Broadcom designs chips, but Taiwan Semi is the one who actually makes them. Intel does both parts.
Right. Okay. And that can be a wonderful advantage, or it can be a bad thing from a profit perspective. But I've become a believer in Elon's philosophy where vertical integration is a good thing.
Sure. And I mean, it all depends on whether or not your design is cutting edge, right? Like that's the key.
So let us know in the chat. Do you guys own Intel? Is this a stock that you've owned or followed or is on your radar in any way? We want to know if we're talking to Intel shareholders. I do not own Intel.
I do not own Intel, though I will say I've benefited from it greatly. Their founder graduated from the same college in Iowa that I did. And it's why my college, Grinnell College, had such a large endowment, because they got in at the ground floor in Intel.
Great.
Great. I will say we are not alone. We are pretty much nose across the board.
Okay, great. Well, let's research this company together and see if it deserves a spot on our radar. Now, if this is your first time joining us in these research from scratch sections, we use Stock Simplifier, our research method, to do this. It is a 7-step process where we start with the phase, move on to the business, moat, growth, key metrics, risks, and finally valuation. So let's start with the business growth cycle. So there are 6 steps, 6 stages to the business growth cycle for now. And we want to know, which of the 6 stages here do you think Intel is in? Let us know in the chat. Which of the 6 stages do you think Intel is in? While we're waiting for those responses to come in, I just opened up a fresh copy of Stock Simplifier, our spreadsheet tool that we use to research it. And I also opened up a copy of all of our prompt library here. I'm going to open up our business phase analysis prompt. I'm going to go over to Gemini. I'm going to paste it in there, and we're going to see what Gemini says is the most, is what phase that it's in. Intel.
We're getting everything from 4 to 6. I would say 5 and 6 are the 2 most popular.
Okay. 5 and 6 are the 2 most popular. Now, I did do a sneak peek beforehand, so I'm curious to see what Gemini says. Okay, Gemini says phase 5, capital return. Why? Because it has positive operating income in the most recent quarter.
And can you zoom in just a little bit?
Sure can. Thank you. Better?
Yep, it's great.
Revenue is negative.
Well, that's not good.
And then it is doing a capital return. So because it's in AI, it says phase 5.
Now, does it say their buybacks were paused?
Quarterly dividend buybacks are currently paused, but program remains authorized.
That is very much a stage 6-ish type thing.
I would totally agree with that. So let's actually go and do the numbers ourselves. This is why knowing how to do the math kind of behind the scenes is important. So let's go to the financials. We're in fiscal. I will zoom in on this. First, let's just start with revenue. Oops. Give me the revenue number here.
Ooh, that's ugly. Oh, that's real ugly.
I see peak revenue in 2021.
Can you pull that back more? Just to like, does it go
I think
earlier
10
than
years is all
2020?
you can do on a
Yeah,
chart.
I'm just curious to see what kind of, there is a little bit of, we know this is a cyclical industry, but what's weird is that we are at a time when chips are, no one can get
Booming.
enough of them. Right.
Well,
And while that's happening, it's going down. I mean, I think Jaspreet has kind of hit on why it's up so much, which is that the trend in onshoring or moving things to your home country, and what other than maybe oil is more important than chip making for the global economy? I don't know. So the fact that it has facilities in the States, I think is where the you always say it's reality times a story.
Yep.
I think that story is why the stock is up almost 200% over the past year.
Well, here's the story moving forward. While it's down, Wall Street's currently expecting, these are estimates. See the little E? Wall Street's expecting some growth in the near term, but that's revenue. Let's take a look at operating profit. I'm sure we're going to see a fascinating number here. So revenue is down, consistently profitable, but this is that cyclicality, right? Look at the bumps that you see here. 2023, horribly negative.
They've just lost the AI chips, right? Like, look, ChatGPT gets released. AI becomes the most important thing. I think it was Thanksgiving 2022. And it's not Intel that's designing those AI chips the same way that NVIDIA and Broadcom and AMD are.
Yeah, so this is going to be a hard company to classify. Let's take a look at the dividends. That's not good. I mean, it's understandable if you understand the operating profit of the company, but this was a consistent dividend payer for, what's that, 20 years? And then not so much.
I think almost 30 years.
Yeah. And then let's go to the cash flow statement. Let's take a look at buybacks. Yeah, this is definitely going to be a hard one to classify. So net issuance of stock, repurchase of common stock. Let's take a look at that.
Yeah, so they used to be repurchasing a whole bunch.
Yeah.
And now
this is the buyback history. So 423 million. So technically they are returning capital to shareholders, but they've basically slashed their dividend.
Yeah,
and they are doing a tiny little bit. Plus revenue is in decline. I mean, I don't know how you don't call this stage 6.
I agree. Again, it's about the story. It's the fact that they've got some political capital now.
Yeah.
And they've got some leverage because they have chip fabrication plants on U.S. soil.
Yep.
And Taiwan Semi's building stuff too. So don't get me wrong, on U.S. soil, but that's a big deal.
To me, this is clearly a stage 6 company. Here's the problem. We built Stock Simplifier so that if you said this company's in decline, that we basically turn off the analysis, right? we basically say, look, there's no key metrics that you can look at. There's no valuation that you can look at. We avoid companies that are in stage 6. That's what we designed it to do. For the sake of actually continuing on, I'm going to say it's in the capital return phase 5,
with the caveat that we just went through. Why?
With the huge caveat, but if you look at the estimates, right? Revenue is estimated to rebound. So yeah, or maybe we should say it's in stage 4 because it is profitable, but it is buying back a little bit of stock. This is a really tricky one. Well, what do you think makes the most sense?
I think if we have to pick one, it's actually probably stage 4 that makes the most sense.
Probably.
It is worth noting. Ray brings up a good point when we were talking about the story. The government owns 10% of this now.
Yep. Yes, they do.
Again, Brad, that's why the stock has doubled, because there is belief that with the government will not let this fail. So is it
the next bank? Is it the next JP Morgan where this company can't fail?
Exactly.
Yeah. I mean, look at the 10-year. I'm sure the further back you go, the uglier it's going to get. But they hit a high of 60 in
It actually
2020.
wasn't terrible. It wasn't terrible from like 2010 up to 2021, but then the bottom kind of fell out. Like
All
that's
right.
not the worst. If
Yeah.
you were to go back to 2020, I'm not sure why it's not showing it. It still hasn't reached its highs from 2020.
All right. Well,
Sorry,
so
2000.
we think that this is a wonderful mental model to get in your head, and it's helpful for thinking about how to analyze a company. Just know that some companies don't fit neatly. This is a
Yeah, it's
company
not
that does
perfect.
not fit neatly. So if you said phase 6, I agree with you. If you said phase 2, I agree with you. But we'll just say phase 4 for right now, just so we have some analysis that we can do on the company. All right. So now that we know that, or at least we have an idea for that, let's take a look at the understanding the business. So what does it do? How does it make money? Is it have recurring revenue? All kinds of those good questions that we like to answer. So I'm just going to say, let's put this prompt in and let's start to analyze the business in more detail. Give me some intel. And let's go from there. All right.
Did you just say give me some intel
Give me some intel.
on Intel?
How about that? All right. Using the data from January 31st and preliminary 2026. Wow. So they haven't filed a 10K from 2020 in 2026 yet?
I can double check on that.
Can you try again and look for a 2026 10K?
This
Let's
is
just
good
see.
practice for how to talk to AI.
Yeah.
No, they did
There
file
we
it.
go.
They filed it.
There we go. Oh, it's for fiscal year 2025.
Okay.
Oh, maybe I just had that wrong. Okay. Intel is the global leader in designing and manufacture of semiconductors. No, it's not.
Yeah.
But it used to be. It is dominant provider of process for personal computers and data centers. Okay, that part I believe. Like unlike many competitors, Intel operated as an integrated device manufacturer, meaning it both
Exactly.
designs and fabricates its own chips.
It'd be like if NVIDIA and Taiwan Semi were together.
Right. That would be a $6 trillion company, not a $200 billion
It'd
one.
be a $10
In its
trillion company.
current strategy, IDM 2.0 focus on expanding its third-party foundry services to manufacture chips for other companies. I think this was related to the CHIPS Act in some way.
Well, I mean, the
right?
bottom line is this is their way of saying if China attacks Taiwan and we use our ability to get chips, we need a safety valve. That's why the stock is up so much.
Sure. It's a strategically important asset to the United States government,
Yep.
basically. Yeah. And that's important. Now, from a cost perspective, by fabricating your own chips, that's a hugely capital intensive business. It's always been that way for Intel. So that means that the company has a lot of operating leverage when things are going well, but costs are high when there's a cyclical downturn. So that's
It's
when
a
that
lot
cuts
like
both ways.
Boeing. It's a lot like
Yeah.
Boeing.
Oh, yeah. Yeah. All right. How does it make money? Intel's revenue is derived from 5 segments. Client Computing Group, which is 56% of revenue. This is CPUs and chipsets for PCs and laptops. So it's core business that it dominated for 30 years.
And it's a mature market. It's not a market that's growing like the data centers are.
Right. Data center and AI. Of course, you put AI in there. 23% of revenue. Servers processed in AI accelerators. Networking and edge, 10% of revenue. Intel Foundry is only 2% of revenue.
That's the thing that they just talked about, the 2.0.
Okay. I guess $1 billion is a decent start, but they have a lot of that has to grow a whole bunch before it moves the needle.
Mm-hmm.
And all other. So Mobileye and Altera, et cetera. I know they purchased Mobileye and Altera. I think they spun out Altera. Yeah. Once again in 2025. So Altera is not a part of them, but that's only 9% of revenue. Autonomous driving and programmable chips. The majority of Intel's revenue comes from a small number of massive customers. Hello, customer concentration risk.
Mm-hmm.
Dell and HP typically account for 30% of total revenue. Other customers include Livono, cloud services provider, and retail consumers through third-party distributors. Well, I think that just when you're in semiconductors, that just is like par for the course.
There's no way around that.
And that How do you feel about that customer concentration? Because it goes both ways. Like they can't exist without Intel and vice versa.
It's one of those things where it's why I would never let a position like that grow to be like 15% of my portfolio. But if everything else checks out, it wouldn't stop me from investing.
Fair enough. All right, where does it operate? Intel has a highly international footprint. The majority of revenue is outside of the United States. So China is 28%, Singapore is 22%. I'm guessing they have a manufacturing facility in these places.
They've got
US is
Lenovo.
only 20%, Taiwan is 14%, and rest of the world is 16%. So this is where they report revenue from. That's probably where their factories are, but that's not where their actual customers are. NVIDIA has the same dynamic, if memory serves. All right. How often do customers buy? Intel's products follow cyclical demand. Individual consumers, enterprise replace PCs every 3 to 5 years. Data centers refresh cycles are similarly timed, but can be accelerated by major technological shifts.
Which is what's happening.
Current AI PC and generative AI server transitions. Yep, I would say that. So revenue is recurring, but the total demand is lumpy. Not surprising at all. Can it raise prices? Intel has limited pricing power due to fierce competition from AMD and NVIDIA, as well as the rise of custom ARM-based chips from Apple and Amazon. While Intel can command competing from first-to-market processors, its gross margins have been pressured in recent years.
Look at that's not good.
60s to the 50s. Let's take a look at
the
that.
40s.
So financial.
I mean, if you want to know if a company has a moat, that's the first place to look. Gross margins.
That certainly is. Or what the direction of that moat. Oh my gosh. 60s used to be in the 60s. So remember, this is revenue minus the cost of revenue, right? So this is an indicator of how profitable is the product or service you're selling. So for every 100 pennies, every dollar in sales, Intel used to make 62 pennies of gross profit. Now it's making 34 pennies.
I agree with Mark.
Profit.
Ouch.
Massive.
I mean, that's bad.
That's like if you want to see destruction of moat, this is it. This is moat destruction right here. Now it has bounced back, so gross margin is on the rise. It could also indicate, to be fair, changes in business model or acquisitions or all that kind of stuff, but that is such a severe decline.
I mean, I think the fact is, remember, they've got the chip design on one side and the manufacturing on the other. And I think this is just them saying, we have lost the chip design battle. And I don't think there's any other way of reading that.
And if memory serves, wasn't revenue going up during a bunch of this period too? Yeah. So revenue went from 55 to 79, and gross margin still fell from 66 to 55. Side note, when I first read like an analyst report, they were talking about gross margin was 62.6%. Now it's 61%. And my thought was, well, who cares? That's like such a small difference. Oh no, small differences really matter in margins. So, and this is a massive, massive difference there. So it's understandable why gross margin fell during this period. What's a little bit more of a head scratcher is, why did it fall during this period?
Yeah.
I mean, not good. Just flat out not good. Okay, what happens in a recession? Intel is highly cyclical and sensitive to the economy. Capital expenditures for data center and consumer spending on laptops are often the first to be cut.
I don't think we know if that's true about data centers.
We definitely do not know that.
But laptops we do.
Yeah. Intel saw significant revenue volatility as the PC market contracted after the COVID pull forward. $2.4 billion restructuring charge in 2025 to align costs with lower demand. So that might be a reason that margins dropped so drastically. All right. So
I want to know what people have to say about this.
What do you guys think of Intel, the business? Red, yellow, green. Red, you're confused. Yellow, you get it, and you kind of think meh. Green, you're excited. This sounds like a great business. And I hate to, the commentary that we offered kind of hints at what we think of this company. But what do you guys think?
They're coming in now. We've got yellows, reds. I will say we've got no greens. We've got I like to say this is like if you get a bloody nose when you have a cold, it's yellow and red.
Yeah. I'm going to just mark it as yellow. I don't know how you could be excited about this company right now. Let's just go with, I get it. I understand that this is a business and it's a semiconductor manufacturer. And even though the industry that it's in has been in boom times, this company has been struggling and ceding market share.
Now, when we move to the next part about moat, this comment from DZ, it looms large, which is we need them. So I'm curious to see. I know what this is the only company where I think that the moat is dependent upon one very simple thing. It's the first time we've said this, but I don't want to influence. So I'm curious what people think.
So on to the moat. So there are 5 potential moat sources: network effect, switching costs, low cost production, intangibles, and counter positioning. What do you think is Intel's largest moat source? Which of these 5 do you think the company is benefiting from? So while we are waiting for those answers to come in, let's go ahead and ask Gemini. What does Gemini think is Intel's moat?
We haven't gotten any responses yet about the moat.
Moat size, none.
Oof.
No
and narrowing. How can you have none in narrowing?
And the
I didn't know that
moat
was
is getting
possible.
worse. Its primary moat source is intangible assets. Okay. Intel has lost its wide moat status as its manufacturing lead vanished, and its x86 architecture faced unprecedented competition from ARM and specialized AI. The company's return on invested capital has plummeted, with Morningstar noting that the current manufacturing struggles offset any residual design advantages.
Brutal.
No switching costs. They were once very strong, right? You built a computer based on top of Intel's technology, but the armorification of the PC market, pioneered by Apple and now Qualcomm, has significantly lowered exit barriers. Okay. Intangibles, it says some, but they're narrowing. Intel means a massive portfolio of 100,000 patents and deep technical expertise. These assets are no longer translate into market outperformance. The Intel Inside brand, once a massive driver, has been diluted by AMD's performance, NVIDIA's dominance. Big R&T investments. Network effects benefits from a developer ecosystem, but does not possess a true network effect. Yeah, I would say NVIDIA's CUDA has taken that torch. That's NVIDIA's software that goes with its chips. Low cost production. Nope. Formerly Intel's strongest moat source, this is now a liability. By falling behind Taiwan semis in process and leadership, Intel now produces chips that are often less power efficient and more expensive than those of its fabulous rivals. And look at that gross margin going down. Counter positioning, not present. Their new strategy is a survival move, not counter positioning. Well said, Gemini. This is different from a pure play foundry. So, and foundry
is getting a little sassy.
Only 2% of revenue. So, side note, I programmed my Gemini to not have optimism bias.
Good.
Like I had to I said, don't optimize for the truth, not for what I want to hear. Don't tell me my ideas are good when they're terrible. So that helps a lot. Primary risks, execution risk. Intel is betting its entire future on achieving 5 nodes in 4 years. Any delay would be bad. They're getting squeezed by NVIDIA and TSMC. And their valuation multiple of PE of 32. Well, we'll talk about valuation in a bit. So don't put any stock in this just yet. But Morningstar says their moat is gone.
Now, what I do want to just point out is I think Scott hit on what I think the moat is.
Great. What did Scott say?
It's intangibles, and in parentheses, it's the government. That's it. Look, if the U.S. doesn't make a 10% investment in Intel, there's no way in my mind that the stock does what it has. That's a signal to certain types of investors that the U.S. government is going to backstop this because the ability to make chips domestically is that important.
Well, let's ask, what about the 10% ownership by the U.S. government and CHIPS Act? I'm pretty sure that the CHIPS Act was very favorable to Intel, is a critical recent development that significantly altered risk profile. They converted billions of CHIPS Act into 9% equity stake. This effectively turned it into a subsidiary of direct investment. The deal structure was $11 billion in total. They got 433 million shares of stock at $21 per share. They're passive. The impact. While this doesn't grant Intel a wide moat, it creates a political moat.
Too big to fail. Look, that's what I
Too
just
big
said.
to fail.
Too big to fail.
Through its okay, 3.2 investment, it's now the trusted manufacturer with sensitive U.S. military and intelligence chips. And by converting, the company eliminates clawbacks provisions, political volatility.
I'll say this. As Taiwan Semi starts building fabrication plants in the United States, that is a serious threat to this type of moat.
They do not fix Intel's manufacturing stumbles, but they do provide a massive capital cushion and regulatory protection. This is the floor of the valuation. All right. Well, what do people think? Given that analysis, would you say red / weakening / no moat, yellow, narrow moat, looks stable, and green, it looks like a wide moat and or expanding? National defense play. Well said, David. It's Chrysler from the 1980s. I like that.
We got we haven't gotten anything but red.
Really?
I actually think it's a yellow. Just
I do
because
too.
I think I think it's the worst at scale in its industry, and it's the only one that the United States has, and that's not nothing.
Yeah. I hate to disagree with the crowd here, but I'm going to go yellow. I think if the government did not step in and throw this company a lifeline, no doubt red, no doubt. But name another like company that manufactures chips in the U.S. that's got the government's. You can manufacture chips for high security, geopolitical reasons. Maybe NVIDIA, but they outsource all theirs.
I like what David said. It's a cigar butt with the last puff already smoked. I mean, look, this is what it is it's like someone who, if you disconnected them from, if you pulled the plug, the government plug, they would die. But they are deeply invested, the U.S. government, in not pulling that plug.
For sure. All right, time to go to growth analysis, long-term potential analysis. So
I'm really curious what they're going to say here.
2 ways that a company can grow: get more customers, get existing customers to spend more. That's it. There are subcategories in there, but let's go ahead and see what analysts are thinking. So this is a company that's negative growth over the last 3, 5, and 10 years. But moving forward, analysts are expecting 5% revenue growth and 28% earnings growth. That would be operating leverage, the difference between those two numbers. So perhaps this is a phase 4 company on that front. So let's go ahead and see, why should we believe that this company has growth potential? And let's see what it says. All right. Using their 10K and most recent earnings. Their next earnings, by the way, comes out in 10 days. All right. So new products, it's 18A Panther Lake, new distribution, the Foundry, and geographic market expansion, sovereign AI, U.S. manufacturing. Sales and marketing investments, weak. Selling and marketing expenses hit a 5-year low, down 30% as the company aggressively cuts cost. Yeah, definitely not investments in sales and marketing. New distribution channels strong. The rebranding and separation of Intel Foundry as a merchant foundry allows Intel to sell manufacturing services to rivals.
Yeah, like, I mean, that could be legitimate, you know? And Ray even said they should split up the company in 2, and this should be one of those 2.
That makes a lot of sense to me. That would be a far more interesting business. But as a reminder, that's 2% of revenue or 3% of revenue. $1
billion
right now.
Sales.
So they have to double that base a whole bunch of times before it's even close to meaningful. Mm-hmm. Geographic market expansion, leveraging the CHIPS Act and the sovereign AI trends, position it as the primary Western alternative to Taiwan-based manufacturing? Definitely.
Absolutely.
Acquisitions, not applicable. No major acquisitions, and the company is focused on divestitures, selling its minority stakes in Altera and IMS to raise capital. That is a company in decline move, not a anyway. Existing customer expansion, moderate. Its data centers grew 9% despite flat unit volume, suggesting improving mix and pricing power with its servers. Okay. New products or services. Yeah, it says moderate for pricing power. I'd go weak unless they really come up with something new. New products is strong. The launch of its Core Ultra Series 3 on the 18A node and Gaudi 3.4, targeting cost-conscious inference market. All right. And then customer retention. PC segment fell 7%, showing some churn to AMD and ARM-based rivals. Intel remains the default leader with 70% of the market. Okay. So number one is its Foundry. This is its new distribution. It's opened an entirely new $100 billion addressable market. They grew their revenues to $4.5 billion with that new product. This is a make it or break it technology that restores Intel performance leadership. So 18A power process nodes. This is the story of revenue over the next couple of years. Data sovereign expansion, acquisitions. They're currently a seller. Heavy debt load, $48 billion in debt. So red, green, yellow. All right, what do people think? Is this a company with low or negative growth potential, good growth potential, or green for great growth potential? I will pull up the numbers there just to show you again what analysts think. Analysts are thinking 5% revenue growth, but 28% earnings growth. Earnings growth estimate is mostly off of a depressed base as opposed to it being a high compounding number or leverage is about to kick in.
Now, see, I will say for this that I'm comfortable giving it a red, and here's why.
I am too.
Here's why. Because I just don't see it being needle moving growth. That's the key. It needs to be needle moving. I like the Foundry. I think that's a great idea.
Yep.
But you've got to prove to me that you can manufacture chips as good as or better than Taiwan Semi. And as I lost the comment, but as someone said, in 2028, Taiwan Semi in the state of Arizona goes live. That will significantly expand their manufacturing capabilities. And so Intel needs to figure out a way to be better than that. I don't think that they're going to die, to be clear.
Yeah.
But
they've become.
You got to convince capitalists to go to you.
For a couple of decades, AMD was the second RAN to Intel. Now AMD is doing great. And so Intel has become the second RAN to Taiwan Semi in that market, and the secondary to NVIDIA and AMD in the primary chip market. I will also say lower negative. Not that this number couldn't be higher or accelerate, or not to say that they don't have growth potential,
but it's low.
It's low. So this is where really thinking into optionality is important. Yes, selling those services to other chip makers is a growth business, but it's such a small base it's starting off of. You have to go a couple of years before it's meaningful. So optionality is only useful if it actually changes the company's growth rate meaningfully. I don't think it can do that. I don't think that's gonna happen for a couple of years. I could be wrong if this business 10x's in a year or something like that.
And the other thing to remember is that the entire chip industry is constrained, right? So that is a tailwind for them.
Yep. All right. Well, key metrics time. We don't even need AI to answer some of these. Revenue growth over the last 3 years, we know that's negative. Operating margin, we know that's declining and declining. Free cash flow margin, we have not checked, but I can't imagine it's not contracting. Let's just check that real fast. Financials, and then if we go to ratios
and margins,
and then margins, and then scroll down. Free cash flow margin, yeah, it's negative 9%. I mean, this number used to be in the 20s. Yeah,
I mean,
that
pretty
same gross margin
consistently
pressure.
too.
That's a 27%. Very, very impressive number in 2020. That was due to the pull forward of demand for PCs and stuff, and then just negative. So
You know,
really bad
one of
there.
the things I
Oops.
like about this the most is that this process doesn't give us the answers always, but it does give us the most important question to consider. And I think
Absolutely.
David hit on it here. Can it grow that part of the business before Taiwan Semi completes their Arizona plant?
Yeah. So let's take a look at earnings results versus expectations. And if we go to, well, first off, here's what's happening to the earnings estimates. So this is analysts changing their mind. Look at the direction there. Down, down, down. That's never good. But if we go to quarterly, how is the company done versus its estimates looking backwards? 12, 13, beat, beat, miss, beat, beat.
So not terrible.
Yeah, we'll go with
Yeah, mostly.
yellow.
I'd say yellow.
Be generous and say there. And then return on invested capital. I don't know how this number is not going to be negative. So if we go to financials and then we go to financial health, oops. If we go to financials and then ratios, and then we go to key metrics, close this down. And then we go to capital efficiency, return on invested capital. Yeah.
I mean, I guess it's headed in the right direction.
Well, what's kind of crazy is look at the numbers historically. Even when they were doing well, I mean, these are okay, right? It's a good, decent enough numbers, right? Mid-teens, but really negative more recently. So barely positive, barely positive and or erratic. So no surprise, the key metrics here look quite bad. All right, next is for risk. Let's take a look at execution risk. How hard is this going to be for this company to execute on its growth / turnaround plans really at this point here? So let's do some execution risk analysis.
And again, so this is one where it's tricky because I imagine this is going to say it's very risky, but then I'm going to push back.
So this gave it a very high risk rating, a score of 2.75. That's out of 3. So the primary risk factors are disruption from ARM and outside forces, geopolitical / debt.
But this key mitigation is important.
Provides a permanent capital floor and too big to fail protection from the U.S. government. All right, concentration risk. This is red. Dell and PC combined for 30% of total revenue. They will still account for a significant portion of accounts receivable and revenue. Okay. Disruption risk. This is a red. The shift from general purpose CPUs to AI accelerators is a structural threat. The adoption of the non-x86 architecture is a huge threat to its business. So disruption is a real risk.
And if you can't help with agentic AI, then you're missing the biggest wave we've ever seen.
Right. Yeah, just shows you how smart Jensen Huang from NVIDIA was to make the bets way ahead of time. Outside forces, red, high exposure to China, severe regulatory risk, debt obligations of $47 billion. The trend is improving due to $11 billion in U.S. government equity. So outside forces is bad. And then competition remains severe. Intel's gross margin has stabilized 36%. All right. So overall, concentration risk, bad. Disruption risk, bad. Outside forces risk, bad. And competition risk, moderate. Offsetting those is really the government. And then the potential foundry separation. And then it's kind of install base of stickiness. All right. Red, yellow, green. What do you guys think? What's the risk here? Is this a red high risk business, yellow a medium risk business, or a green a low risk business? Still, I think I know what people are gonna vote for.
Well, while they do that, I'm curious. Well, one, I want to hear what you think, but then I want to hear what you think I'm going to say.
Okay. I think that I'm definitely going to say red. I don't care about the backing of the U.S. government. I care about what the risk that matters to me as a potential investor is if I buy this stock, what are the odds that I'm going to lose money? What are the reason and probability that I'm going to lose money?
Mm-hmm.
I think the reason probability there is high. This company has a lot of balls in the air. It's actively trying to rebuild its business, and it's not doing so in an environment where it has no competition. There are market leaders that this company is competing against, and it's competing against Taiwan Semi, fabulous company, Nvidia, fabulous company, ARM Holdings, fabulous company, not to mention all of its former customers like Apple and Microsoft are now making their own chips internally. Mm-hmm. So I don't know how you look at that situation and don't think very high execution risk.
I'll say yellowish red, just because, again, the way that I would buy this is the thing is a lot of it depends on the valuation, which we haven't looked at yet, because there is a floor. And someone asked, is this government protection? Will political winds change this? I don't think so. I think whoever is in the White House or whoever is in Congress, they know that the U.S. needs this. The thing that's a bigger risk for losing that support is Taiwan Semi's locations in the United States.
Fair enough. Yeah, but if we want to become chip independent, if the U.S. wants to become chip independent, that's going to require years, and I can't even imagine how many billions of investments.
Yep,
maybe even trillions.
Yeah,
of investment. Either way, I think this is a high risk situation. I think it's very high risk. All right, I gotta fast forward through a whole bunch of these slides here. All right, thank you for everyone. Okay, valuation time. Now, boy, is valuing this company gonna be hard.
Yeah,
really, it's gonna be really tricky. I think again, it's in decline. It's in really the turnaround phase. So that means multiple analysis looking backwards is very shaky. I'm probably going to argue that price to sales is likely the best way to value this company.
Or price to gross profit.
Or price to gross profit.
I think those two, I'd look at price to sales backwards and forwards, and price to gross profit backwards, just because we don't have the forward price to gross profit. We're weirdos that pay attention to that.
So think through this company. Let's go through this income statement for a second there, and I'll even zoom in on this just so people have this mental model kind of in their head. So revenue has been going down. Yeah. That means that gross profit has also been going down. Gross profit is down. What's that? It went from 43 billion to 17 billion, right? So that's profitability at the product level, not including overhead or anything like that. Operating profit is now negative. So this is a useless metric.
23 to negative 12.
Anything below this number here is a useless metric to us. Like you can't use PE, you can't use price to EBIT, you can't use any income number that turns negative is useless from a multiple perspective.
Yeah.
Price to forward earnings. So assuming that they turn all this numbers around next year, that might be slightly useful depending on what we say. So that's why we're saying price to sales, which is this number here, or Stoffel said price to gross profit, which is this number here in the denominator, might be useful to look at to value this company. So let's take a look at both. So in the trailing valuation, we'll go price to sales first. By the way, do not use dividend yield. Definitely do not use dividend yield. Mm-mm. Do not use buyback yield. Do not use shareholder yield. Those would be mirages at this point. All right, so let's take a look at price to sales. All right, so historically, this company traded at, over the last 10 years, I need to unzoom out 1 second. If we put a middle line through there, this is a company that is traded at about 2.7, call that, times sales. At the absolute lowest, it traded about 1.4 times. The
government made a very profitable investment.
Now 5 times sales. So it went from 1.4 times sales to about 5 times sales. The average over the last 10 years. Keep in mind, this is when it was doing peak profitability, right? It was cranking out great. The numbers look great here, and the market valued it at about 3 times sales. Currently 5 times sales. That's a very useful data point, I think. That's probably going to be my favorite.
I think it's going to get even uglier when we look at gross profit, because we know those gross profit margins have gone down.
How could it not when gross margins are going against you? Oof. So here's Stoffel's metric, gross profit. So again, historically, this company was valued at about 4 times gross profit, 4 to 6 times gross profit, call it within that range. At the lows, it got down to 3 times gross profit. Currently, 14 times gross profit. So let's go ahead and put the average in there. I'm guessing the average is going to be, the average is 5.
It was pulled up because of what's recently happened.
And that it's definitely been pulled up. The average has been 5 over the last 10 years, currently 14. Now, let's be fair and look at some forward numbers too. So on the trailing numbers, I don't know how you say this thing isn't crazy overvalued. So let's pull in some forward numbers, which assumes we're going to be growing again. Let's take a look at price to sales. Okay, forward price to sales, that same thing. So 5 times forward price to sales. Price to earnings. Wow, if there's a metric I would not trust, it would be this one. But let's look at it. So 107 times price to earnings.
Doesn't mean anything.
Junk data to look at. And then price to operating cash flow. What was the other one? They don't have price to forward.
They don't have gross profit. You can do operating cash flow, but
price to operating cash flow. So this does not include capital expenditures. It's just cash production at the business. 18 times sales. All right.
So here's what I would say. Now I'm comfortable saying the risk is red because there is ground level protection, but we're so high above that ground level.
Yeah.
That the benefit of that won't help you if you buy today.
What do you guys think of the valuation? Red, it's overvalued. Yellow, it's fairly valued. And green, it's overvalued. Actually, while we're here, let's take a look at one more number, which is not something I typically look at, but it might make sense given the state of this business. Price to book. Price to book. So this is the price of the company compared to the assets that it has on its balance sheet. So currently trading at about 2.2 times book. Now, this is a great metric for measuring banks and insurance companies. It's basically like if this company was chopped up and sold compared to its assets, what's the market value of them? So it's 2.2 times price to book. Not at all my favorite metric to look at here, but at least this does show it from a different light.
Yeah. Now, to answer this question from a YouTube viewer, this is the reason why with, say, a stage 3 company, you only use price to sales and price to gross profit is because you don't have earnings and you don't have free cash flow. So that's why we use those tools for companies that are there. Intel doesn't have those things right now.
This is why that business growth cycle phase we put at the beginning of this. If you weren't here, we understand, but the business growth cycle, it's so important to understand where the company is on the phase of its life, because that indicates to you what metrics you should pay attention to, what valuation metrics you should pay attention to, what management is focused on. So the metrics you should look at to judge them. We think it's foundational to look at a company's phase, because otherwise the metrics you look at later might not make sense.
Yeah. By the way, we got all pretty much all reds for valuation.
All right. So let's see. This is a mildly interesting business with a government granted moat that has bad growth potential, pretty poor performance on its key metrics. It's high risk and it's overvalued. So what do you guys think of this company? Is this a buy? Is this a put it on my watch list? Or is this a put it on my pass list? Actually, well, sure, we'll get to that. We do have some other analysis we want to do now that I think about it. We can do sentiment analysis. So let's do some quick sentiment analysis. So why is the stock doing what it's doing? Why has this stock doubled over the last year?
Yeah, it almost tripled.
Basically tripled over the past year. All right. Stage a massive turnaround driven by the U.S. government's 10% stake and a sellout of its 2026 server capacity.
Which is still just 1% of their revenue.
Sentiment has shifted from survival mode to execution mode as the company successfully hit its milestone. Okay. The technical turnaround is evident. The stock has rallied, leading many analysts to believe near-term bull catalysts are fully priced in. So analysts are neutral. The investing community is bullish on this company, apparently. And the media says we're mixed. the transition from extreme skepticism to optimism, given the AI supply and the massive government subsidies. So basically, the government stepped in. I can see how that dramatically shifts the tone related to this company. In April, they moved to buy back Apollo's stake in Irish Fab 34, signals improved cash visibility, and the bulls say manufacturing parity. They're finally closing the gap with TSMC. They saw a 10 to 15% price hike on servers, and the government bought them. The
I
bears
agree
say,
with what DZ says. I would love for them to make it work, but I'm not so sure about it.
They're losing money on the foundry. They have high execution risk, and their valuation is quite pricey.
Now,
so overall on that,
Brian, one of the biggest things about this, by the way, we got pretty much all reds for Are You Interested? But the management team plays a huge role in whether or not they can pull that off.
Massive role. Now, the current version of Stock Simplifier that we just showed you does not build in management assessment. But the new version we've been working on in the background for a couple of months does. So let me give you a sneak peek of what that looks like. I queued this up kind of beforehand. So this is what the new Stock Simplifier looks like. So it's a multi-step process that we go through here. So let's just read through what it says about the management team. Okay, so it gives it a 3 out of 5 rating, decent. The new CEO is Lip Bhutan, who cut the workforce 32%, divested non-core assets, and put $25 million of his own money into the stock. His EDA software background is untested in semiconductor manufacturing. So we have details on him. Okay, so Tan led Cadence Design Software for 12 years. That is a software company, a fabulous software company, transitioning it from troubled to consistently profitable. And now he's trying to do the same at Intel, but their foundry challenge are manufacturing, not software. So may or may not be within his skill set to do this.
Yep.
Workforce reduction. They reduced headcount by 40,000 people. They sold their stake in Altera for an $8 billion loss, but that showed that they're willing to take painful action. And the board has limited patience. His predecessor, Pat Gelsinger, was forced out by a board that lost patience. So Tan has 2 to 3 years to show results before similar pressure could resurface. So in the new Stock Simplifier, we tell you who the founder is, Gordon Moore. He founded it way back when, after leaving Fairchild Semiconductor. And Lip Bhutan, he's been the CEO for less than a year. He owns a $23 million stake. Well, that's less than the $25 million he
just
put
because
in.
the price went down.
Yep. He's the former CEO of Cadence Design Software and longtime semiconductor investor. He purchased $25 million of Intel stock on the open market before becoming its CEO signaling person. So this is the kind of thing that we do for you in the new Stock Simplifier. And then we ask some questions like, hey, what do employees think of this company? So they give it mixed reviews. Glassdoor has a 3.8 rating. I mean, when you fire a whole bunch of people, it's kind of hard to have employees like what you're doing. So we would say that that's yellow. And if you want more details about these things, here's a cool mechanic that we built in. You just click and it flips the card over and it gives you some detailed sentiment analysis on employee sentiment. All right. Do they beat expectations? They beat in 2 of the last 3 quarters under his guidance, but the expectations were very low. Is management shareholder friendly? Well, they bought a bunch of stock, so that's good. And then we ask a financial question. How strong are free cash flow margins?
What happens if you click on that one? I'm curious.
So it says the debt to equity rose, earnings are barely positive, and debt is manageable but static. So it's mostly focused on debt, it looks like. But driven by the chip X.
Hey, Brian.
Chip equity, yep.
One quick question, because someone's asking, like, do you talk about why these things are important? Can you just show what happens if you click on that, like the different things that will explain, like the icon with the eye right there?
Oh yeah, if you want to know why is this question included? So we have these little information buttons that kind of explain why we include the metrics that we are kind of throughout. So we kind of built education in. It's it's a massive, massive upgrade over what we're currently doing. So we did want to show you this management thing because we got a lot of feedback from people that you never talk about management. So in the new one, we do. So there's a little sneak peek for you. So management apparently has a little bit of skin in the game here, and successful track record in software, and now they're taking on a whole new business. What?
They've done the painful things too that are necessary.
They are doing the painful things here. So, okay, now we can finally, answer the question. I think a whole bunch of people said red, right?
Yeah.
Do they want to own the stock?
Yeah.
Very, very understandable. So anyway, there's another sneak peek at the new stock simplifier. What's cool is last week we did allow people that purchased the original stock simplifier to upgrade as beta users. Over the next month, we're going to be collecting feedback from them, finding bugs and kind of smashing them out. And then we are going to be launching the version that you just saw in May. So if you're interested in learning more about that new software and getting on the wait list for it, just go to longtermmindset.co/waitlist. Stoffel, if you could share this in the chat, that'd be very helpful. If you just put your email in there, we will keep you updated with what's happening in there. But in early May is when we're going to be allowing the waitlist to check out the new version of Stock Simplifier. It is night and day better. We've been working on it for months. So if you like what you saw with the management, wait till you see the rest of it. It's so good. And the feedback that we are getting from people has been phenomenal with how much they like it. So again, if you're interested, check out the wait list. We think that we know it's been a bit of a wait for us to announce this, but we think it'll be worth it.
Yep, totally agree.
Yeah, massive step forward. Thank you for saying that. All right, so that was Intel. For me, it is definitely a not even putting it on my watch list. Way too high risk, way too much of a turnaround. But the government sanctioned monopoly does seem to be there. Thank you guys so much for spending some time with us today. Tomorrow is Wednesday. We will be putting out a newsletter with you for 4 more companies for you to vote on, and we'll be back next Tuesday to do another stock from scratch. So we'll announce on Sunday, as usual, what stock the newsletter subscribers have picked. So until then, thank you guys so much for watching. Have a
good
wonderful
week, everyone.
Tuesday. Bye.